Alta Mesa Holdings is a privately held company focused on operations here in North America. The company has a unique position within the private oil and gas sector as its debt profile is held in the public markets. Joining me now is Hal Chappelle, President and CEO of Alta Mesa. Good morning, Hal.
Good morning, Quinn.
Now, your core operating areas include some prolific fields. Talk to us about these areas and which ones are you most optimistic about and why?
Okay. Well, the two basic areas in which we've invested heavily and where we operate today are on the Gulf Coast of Texas and Louisiana, and then also in Oklahoma in the Sooner Trend field, which is part of the Anadarko Basin. In the Gulf Coast of Texas and Louisiana, our major assets are the Weeks Island field, which is just south of Lafayette. It's a prolific salt dome oil field that originally was developed by Shell and Exxon, I believe discovered in 1945. The field's produced about 285 million barrels of oil and a TCF of gas in its history. We acquired that together with a number of other assets when we acquired a small publicly traded company called Meridian Resources almost 2 years ago. And so our objective in a field like that is very simple. We want to find a way to get another 10% out. And we believe with the advance of technology, with the focus that we can bring, we can find opportunities like that in the oil and gas industry. Other areas where we're very excited are elsewhere in South Louisiana in some smaller fields. We're literally invested from the Sabine River, the Cameron Parish, which is the border with Texas, all the way over to the Pearl River, which is the border with Mississippi in St. Bernard Parish. So South Louisiana is an important part of our portfolio. In Texas, our most important fields are the Hilltop field, which is really, I'm exaggerating a little bit to call it Gulf Coast because it's really East Texas, and historically it's been a prolific deep Bossier gas producing field. At least for the last 10 years or so, that's been the focus. With the recent drop in natural gas prices and a renaissance of interest in some of the shallower oil zones, we and other operators in the area have targeted the Austin Chalk, the Buda, the Glenrose, and the Woodbine. In fact, there's a play in the area called people use this term Eaglebine, which is just a notation for saying it's a combination of Eagleford and Woodbine. We're very excited about that area. It's been important to us. It will continue to be important to us. Our other core fields, if you will, in the area are just a little bit to the south of Hilltop and just outside of Houston in the Montgomery County, San Jacinto County, and Polk County areas, where we're pursuing opportunities in what we would term the normally pressured Wilcox and Yawa formation. Those formations are typically oil and liquids-rich gas. We also have opportunities that we're pursuing in the Austin Chalk, which is deeper, and also in the Midcox and the Woodbine even in this area. Our other core field outside of that, as I indicated, is in the Sooner Trend area, just to the north and west of Oklahoma City in Kingfisher County, Oklahoma. There we're in 5 different fields with about 65,000 gross acres. In 3 of those fields, we are the largest working interest owner, 80 to 90+%, and in some individual wells, 100% working interest owner. The theme there is very similar to what I described to you with Weeks Island. At Weeks Island, Exxon and Shell were our predecessors. In Oklahoma, our predecessors, if you will, our ancestors, were Conoco, Texaco, and Exxon. And these companies, very, very good operators, they discovered these fields, they developed them, and then they had better things to do with their technology, their talent, and their resources. And so in the 90s, they began divesting of some of these fields. Well, Alta Mesa found a way to make acquisitions, and we're not unlike many other smaller companies in doing that. We look for opportunities where we can come in, create focus, bring new technology, literally create new knowledge, and then apply that knowledge in these areas. In Oklahoma, in the 20 years that we've had interest there, we have steadily increased production. And while I'm excited about every one of our fields, and other areas that we're looking at, Oklahoma perhaps has the greatest upside in terms of a proportionate step change that we can make. The local area has been very heavily invested in, if you will, because of the Mississippi lime play. You may have heard that from some of the other people you've interviewed.
Sure.
So the Mississippi lime, the Woodford Shale, the Hunton, the Oswego, the Big Lime, and I could go through another dozen different zones that pay somewhere in the geologic column there. And so our focus this year has been to pursue knowledge, create knowledge in the Mississippi lime by reactivating well bores that have just been left dormant. Were left dormant in the past because the original operator, Texaco or Conoco, had more focus on the shallower zones. We've gone in, reactivated some wells, we've deepened wells, and we're trying to create a body of knowledge that will now allow us to pursue, hopefully, a horizontal drilling program similar to what others in the region have been able to do. So our core assets, South Louisiana, Gulf Coast, Oklahoma, where do I have the most excitement, if you will? Well, the excitement's everywhere. I think that big next step can actually be in Oklahoma.
And you mentioned earlier briefly about natural gas prices. Looking into your crystal ball, because we all have them.
Yeah.
Where do you see oil and natural gas prices headed for the remainder of 2012 and into 2013?
It's a tough question, and so we're literally a price taker in this market. We have to just recognize there's macroeconomic forces that drive supply and demand. So an important part of what we do is hedge. But if you ask me what my view is on natural gas and oil prices for the next 18 months, I think natural gas prices have more potential to languish where they've been in the $2 to maybe $3.50 range than for them to go above that. The economy is such a driver of all these things. Weather is an important factor as well. However, we've been so successful as an industry to go out, develop new technology, find new ways to find natural gas, which is such a good fuel for so many things, a feedstock for industrial processes. We've created a big overhang, if you will, of natural gas there that is going to take some time to work off. So I think natural gas is not really going to go up very much. As a reflection of that, we hedge actively. We manage our portfolio on an active basis. We recently entered into a very small trade, but it was a swap when the market ran up maybe a month ago at 306 for the balance of the year. That was in the money the first month it settled. Right now it looks like it will be the second month. And it's just, it just reflects sort of a bearish view that I have about natural gas. When it comes to oil, I think that these global tensions, Iran, Israel, all those things are so overwhelming that the potential for oil prices to stay high, and I think they are high today, is very great. However, supply-demand fundamentals, the economy, and here in North America, again, our ability to apply technology in places like the Bakken, in places like the Eagle Ford. Well, we're in Eagle Ford as well. Those areas that have generated so much build and supply that it creates a pressure, supply-demand. There's a lot of productive capacity, therefore prices could go lower, and in fact we try to protect ourselves from that as well through our hedging.
Well, can you really quickly mention your hedging program? Can you quickly tell us about that? It's been fairly successful for you.
It has. We've taken a philosophy that we need to be very, very conservative in protecting the downside, and we have I don't know if it's a luxury. I think it's a great blessing for us to be able to go ahead and provide price protection on the core producing assets that we have, and recognize that the rest of our portfolio is really, in financial terms, and I don't have an MBA and I haven't taken a course in option theory, but it really is a portfolio of options at different strike prices. So in the deep Bossier, if prices go back up, I have the ability to drill a well for $9 million. Historically, that's yielded 11 to 14 BCF. And so the finding and development cost, or F&D, has a certain strike price, right? So I have those options anyway. Our company has the ability to grow, so let's protect our downside. How have we done that? We've taken a long view. We hedge out 5 years all the time. We look out and try to maximize the price protection. Today, we have 85% of our proved, developed, producing reserves for the next 5 years hedged at average floor prices for gas of about $4.70 and for oil of just over $98.80. That's a very good foundation financially. When I say average floor price, what I mean by that is we don't just hedge what I would call fire and forget swaps, which may have been all that a producer could have done 5, 6, 10 years ago with banks. In other words, you enter into a swap contract for the next year at $3.50, whatever that is. Today we have the ability to use very plain vanilla options, puts, calls, short and long, and create very robust structures that give us the ability to continually optimize. And as a result of that, we have a lot of our portfolio that has a floor price without an upside constraint, particularly on oil. That's very important, particularly for oil, because you've seen oil prices go up to $140 or more. Yeah. Well, we wouldn't want to be stuck with $110 in a $140 oil market. And that's not really greed, that's just prudence, because a $140 oil market carries with it a different cost structure, right? And so we need to always be looking for that. So I guess bottom line, active management, take the long view, recognize that our assets are a portfolio of options at strike prices, and then trade accordingly. The last thing I'd say about hedging is we do use good professional advisors that are in the market all the time, and they work with us day in, day out, and give us good execution, give us good price transparency, competitive pricing, and good recommendations. And just staying intimate with them, with good people internally to manage that, is a real key to the way that we execute our hedging.
Well, Hal, we sure appreciate your time today, and thank you very much for all the insight.
Thank you very much. It's great. This is a great opportunity. Thank you, Quinn.
I'm Quinn Nguyen for oilandgas360.com.